Hello, guys, and welcome back to another episode of Huddle Up. Today with us, we have Gideon Greaves, the head of investment at Lisk. And Gideon, thank you for joining us today.
I appreciate it, Dren. Thank you so much for having me on the show.
I don't really want to go back to we used to ask people about their background story and everything, but I really want to get into it and start talking the real things. So
let's go.
I know that you're a really big, you're really vocal about how Web3 is really necessary and important for emerging economies. And coming from a developing country myself, it makes sense, right? Because I know if we implemented different Web3 technologies or let's say stable coins, life would be easier, in many aspects, especially banking. But if we're being real here, how realistic is that if we take into consideration the amount of education needed, especially in emerging countries, or let's say my country, to educate people and get them familiar with Web3, DeFi, and everything in between? Because, I mean, I'm here since 2020, right? And I still have some issues navigating through the space because it moves really fast and it's really fragmented. So I really want to get your opinion on that.
Yeah, it's a good question. I mean, it's a loaded one as well. So feel free to stop me if I blabble on for too long. But I mean, obviously the space that we're all passionate about has come a long way. It's a very complicated infrastructure technology. So it's less tangible than something like AI, right? Where our grandmothers can pick up their cell phone, interact with ChatGPT and understand the value of AI immediately. So from a retail standpoint, it's very obvious what value something like AI can bring. Where Web3 is obviously different. It's an infrastructure technology. It's very much in the background. So when Bitcoin launched, everyone theorized how this technology, blockchain, can transform legacy industries. But at the same time, the market went in a very, very different direction, right? Those use cases, that utility that we all spoke about, didn't happen. The market is changing now and it's becoming more mature, more institutionalized. We're seeing those use cases coming. But the focus was on speculation and leveraging blockchain's technology to create crypto and having these coins. And obviously it came at the same time that you could easily buy stocks as well. Apps were launching like Robinhood. So the whole user experience became incredibly easy to start interacting with these different coins and cryptos that were launching and listing on exchanges, etc. So the focus became on speculation. And I think that there's a huge shift now. The market has matured a lot. And I think the history of crypto did bring a bit of a bad reputation to wanting to regulate it, to understand it. So when you engage with any regulators or banks or any institution that needs to adopt this technology to, disrupt their current way that they work, they would sort of be very standoffish about it, right? Because of the reputation. Things have changed. We've got people like Larry Fink that are preaching tokenization, etc. So now people are starting to pay attention. At the same time, the other speculative world still exists. If you look at 2017, there were only 3,000 tokens in the market. Of course, the market went through cycles, but you could be a very dumb fund manager and you could do very well for your investors because everything was just going up. Unless you obviously invested at the top of a cycle. Now there's 40 million tokens in the market, which is insane. All the liquidity is sucked into these shitcoins, basically, and meme coins. And even the great projects out there, the layer 1, layer 2 protocols that have these coins, the use case is not really there, right? So it's segmenting the customers into two. One is someone that actually uses the infrastructure or uses the app, if it's a consumer-facing app or whatever it is. So they're actually using this product because it's solving a problem for them. That's the one customer. The second customer is the one that airdrops or they're getting involved in the airdrop, and they're chasing after the investing in the coin because they believe that the value will appreciate, but they don't care about the product, right? And eventually it comes down. Even the best projects, the likes of Polygon, for example, have done terribly in the last couple of cycles, even though there is still a lot of adoption on their chain. So the link between the usage of the product and the crypto or the coin itself is not there anymore. But for us, it's a good thing because now we're starting to see the focus is becoming more and more on the utility and the true use cases. And just as a caveat, that world will never stop. it will continue to flourish, and exchanges will continue to do super well. And exchanges will sort of have to start picking a lane eventually, where they'll either be known as sort of like a more tradfi exchange, where you go to do serious investing or trading, or more of the gambling one. But gambling and betting will never stop. In fact, it's becoming a pandemic now, basically. So that will never stop. So crypto is still going to thrive. But at the same time, now we're starting to see real stuff coming to the surface, which is super exciting. And I think the developed markets have been the ones that have always driven the speculation. They focus more on the speculative side of the crypto economy, where emerging markets are not using it to make money quickly. They're using it because it's the only way to solve a very specific problem. So I think from an investment standpoint, if you're not investing in tokens, which most funds are not anymore because they've lost all their money. So even the first vintages of VC funds that launched and made a shit ton of money investing in these private token rounds and getting liquidity within 6 months to 3 years, distributing funds back to their investors and to their LPs. Their second vintages, everyone is down. The funds have done terribly. LPs are screaming. They're super angry at the VC firms because they've done terribly, right? So the shift is now more on the utility side. And on the back of that, where those founders, entrepreneurs are coming from is going to be in emerging markets. And to give you, so most of these use cases are going to be finance related and fintech related. So I think that's where the original adoption is going to start this year. And then it will branch into other things. But to give you like a very good example of a company we invested in a while ago, like a very tangible example for your listeners would be a company in Nigeria called House Africa. They verify property on chain. So it's a very layman use case. It's very simple. They put title deeds on chain. You can see who the true owner is. But in Nigeria, 60% of court cases are attributed to land disputes. So they actually have signs in parts of Nigeria that says land not for sale. And the founder of this company actually lost $18,000 on a deposit that he put down for an apartment that wasn't being sold by the rightful owner. So that now they've got government and developers involved and the company's doing really well. But the point is that if this same use case launched in Switzerland, for example, or Japan, they don't need that. It's not solving a problem. They don't have that issue there, right? So whilst the whole world will adopt using blockchain as a verification tool, they don't need it now. So adoption will start in emerging markets, and eventually, developed markets will do it because it's a technology upgrade. But it's going to start in emerging markets. But I still think we've come a long way. I think this is going to be the year where we're going to see some super exciting adoption. We saw the announcement from the New York Stock Exchange last week about exploring tokenization there as well and launching that blockchain venue. But I think that the main focus now, I mean, there's a lot of crazy startups that we see tokenizing real world assets. Obviously, the most popular one outside of financial products is real estate. But I still think that the main use cases where the focus should be from an investor standpoint and where we're going to see the most traction and adoption is going to be everything centered around fintech. And then in terms of tokenization and RWA, that's going to start with financial products first. And once they've gotten that right, then we'll start seeing some alternative assets being tokenized and some other really interesting things. But I think that's not going to happen this year. I think this year will be a lot of fintech use cases, obviously a lot of payments, stable coins, and then tokenization of financial products, stocks, private credit, even private funds as well, which could just bring liquidity and secondary market activity, etc. So emerging markets is definitely where it happens. But to answer your question, it's super hard. Like regulators don't know how to regulate it. They don't know what's going on. But we are starting to see lots of sandboxes pop up. We've seen one happen in Kenya recently. So there is starting to be more and more of a concerted effort to understand the technology and allow entrepreneurs to start using it to solve problems. So I think things are going to change very quickly. Of course, some governments, some emerging markets are still going to push back on this technology. But I think in time, as they see their counterpart countries starting to adopt it, it'll eventually start rippling through.
Yeah, and I'm not gonna lie, it sounds very refreshing. I mean, to hear this because coming from a place where I'm also in this industry for like 5 years now, and it's the first time in my life that I'm having it hard to explain to people why it's worth to stay in this industry. Because, as you said, you have a lot of projects that launch tokens just to extract value from their users. And even some of the best crypto projects today, they don't even have a token. And maybe that should be the case for a lot of other companies. And yeah, like I get the point that, for example, in the US, the internal rate of return is negative, if I'm not mistaken, right now. And yes, you could make a case that there's this kind of herd mentality, you know, in the Silicon Valley and all that. But like, why bet, for example, on regions where there could be political instability, maybe, and that maybe could like wipe out gains overnight? For example, I mean, on top of my head, I'm thinking of Argentina, for example. I'm not saying that the U.S. has political stability, you know, but just this is my take.
Yeah, no, it's a good question, and I think there's an old school philosophy by Warren Buffett, which is a bit of a cliche, I guess, but he always says invest when everyone is fearful and sell when everyone is greedy, right? So at the same time, it's also a timing thing. So I've been investing into crypto startups for the last 6 years. I started only in Africa, and now with Lisk, we're investing across emerging markets. But the companies that we were seeing 6 years ago were really interesting. House Africa was one of them. So that's not a Lisk portfolio company. That's from a previous fund that I was running. But the use cases were fantastic. The builders were passionate, and you could see that they were trying to build something meaningful. But at the same time, there was no adoption. Like the use case, everything was still being marketed as we're a blockchain company. Blockchain needs to be more in the background. The user experience was very clunky. No one wanted to integrate with any of these apps. So I think even that philosophy of Warren Buffett's that I mentioned, whilst there's a lot of truth in that, I think timing is a big thing. And now I think the timing is different now. I think the timing has changed, and this is a great time to be investing into emerging markets. Not only from a Web3 standpoint, but to answer your question more directly, I think emerging markets have changed a lot over the past couple of years. And that's also mainly due to, there's many reasons. One of them that I've sort of theorized is that the US, the venture capital ecosystem is not in a good place right now because there's just way too much capital there. So the average yearly return, or IRR, of VCs in the US over the last 3 years, from a report that I read that was written by Cambridge Associates, is minus 2.7% on average per year over the last 3 years. So venture as an asset class is dead at the moment. And Roelof Botha, who's the managing partner, also a fellow South African, but he's a managing partner of Sequoia Capital. You know, he's from the PayPal Mafia days. He was the one that was talking about this recently on the podcast, and has constantly spoken about it in various interviews as his core thinking and narrative. And he actually recently resigned from Sequoia Capital, not because of venture as an asset class being dead. He's onto other things, but he was just saying that there's just too much capital in the US. So if you think about it as an investor investing into a VC fund, it's usually a 10-year horizon, right? A lot of the startups fail, so it's super high risk. You're very illiquid. You can't get your money out as an investor. But on the back of all of this, the idea is that you're going to get outsized returns. So you investing in a VC fund is you're going to beat the market by being able to do that. So you're going to perform better than gold or the S&P 500, etc. But lately that has not been the case. So also these startups are overvalued, right? Like you pitch to a startup, a US startup pitches to, it doesn't have to be in AI, Web3, could be in anything, biotech, whatever. They wouldn't even have started the business. It's already a $30 million valuation with basically a pitch deck and an idea. We invested in a company now in Kenya at a $3.3 million valuation. And last month in December, they did $1.6 million in transaction volume and $25,000 in revenue. So there's also this valuation arbitrage. The point of all of this is I think that a lot of money is going to start flowing from developed markets like the US into emerging markets, because it's the only way that they can start making outsized returns again. Of course, they are going to look for markets where these apps or products or startups can expand to 100, 200, 300 billion dollar valuations. And Africa is a great example because you can launch something in Nigeria and it can scale throughout the whole of Africa because the problems are very similar. It is super high risk, and I think there's a lot of political instability in a lot of areas. But I think that also, where there's a lot of problems, there's a lot of startups coming up with solutions. So I think that there's always still concerns, and it's one of the questions I get a lot from LPs as well, that to invest into our fund, is the concern on what's happening in emerging markets, or the political instability, or like Argentina with their inflation, and that's a great example as well. But I think where there's problems, there's always opportunity. And there's a lot of entrepreneurs. I know I'm speaking a lot about Africa, but there was an interesting statistic that came out a while back by the African Development Bank that showed that 1 in 5 working age Africans own their own business. So that makes Africa have the highest entrepreneurship rate in the world. Now, that's not because we have the infrastructure of Silicon Valley, but it's because they have to. So you're becoming an entrepreneur and a business owner out of necessity, because there's no other jobs, and it's the only way to make money. So you've got a set of people, and I'm using Africa as the example, but there's a common thread in all different emerging economies, where you have entrepreneurs that are emotionally attached to their product and their service. They view it as an extension of themselves. So these are the type of people that persevere and pivot and build something exciting. So I think there's a lot of different recipes for success in emerging markets, and it's coming at the time where a lot of capital is starting to flow. We did this statistic report internally to show the amount of unicorns that came between Latin America, Southeast Asia, and Africa since 2015. And in 2015, there were only 2 unicorns. From 2015 till the end of 2024, I think the data is, it is 2024. There's now been 72 new unicorns that have come up in these regions. So it shows you that these products are scaling. When you're first raising capital in an emerging market, most of the time it's from a local angel or investor. These VC ecosystems are not very mature, so there's not many local investors. The initial check usually comes from inside the country, or at least in the geography. But then when you start to raise Series A and Series B, there's not enough capital internally. So you have to go look at developed markets. So my theory is that these markets are going to, like the US, are going to be forced to start looking to invest elsewhere where there's traction and valuations are rational. There's big problems to solve, especially from like a banking infrastructure, banking the unbanked, et cetera, et cetera. So there's a lot of risk, but I think there's a lot of opportunity as well.
Yeah, and I mean, you said yourself, there's too much money, too much capital in the US, and dispersing that into emerging economies would be a good bet, in my opinion as well. But an issue that I have with VCs in crypto is that I think let's say some of the new founders in crypto, they enabled some of the VCs and vice versa to just launch and raise money and do these private sales and then dump on their communities. And I think that hurt Web3 as an industry quite a lot. And I've seen like projects that raised hundreds of millions of dollars. I mean, they don't even provide a product after they launch the token, right? But yeah, I mean, it's changing. As you said, you guys at Lisk are focusing on actual products, actual services, and actual solutions to people that need a solution and that can be provided from Web3. So now that we're talking about Lisk, how are you guys trying to fix this VC problem and this gap, let's say, between actual real use products and services and the money that is needed to be like dispersed in these emerging economies? I hope my question was not way too long, by the way.
No, sure. And if I don't answer it correctly, feel free to ask again. But so Lisk, so our fund is focused on investing in Web3 startups in emerging markets at a seed stage level. The first check that we issue is between 100 and 250K. We have 5 portfolio companies currently, and we're constantly deploying and looking for new entrepreneurs to invest in. We only invest in equity, right? So we don't invest in crypto. So that's to answer that part of the question, because in emerging markets, we don't really see any projects that have a coin that makes any sense. And I think in developed markets, whilst there's a lot of interesting crypto projects that are out there, most of them fail, even the really cool ones. So when you see this token going from $1 to $100 and on coin market cap, they suddenly top 30, or on CoinGecko, that starts to make people think that the market is changing or there's opportunity out there. But that's 1 in a million, literally. And sometimes you just get lucky because of the community, because of the tokenomics, because a lot of people caught onto it, or there was KOLs that were really pushing it and it just caught fire. But most of the time, people are sick of losing money. So, it hasn't been doing well. And at the same time, the token, that makes no sense. Even for great projects, it still makes no sense. I met a super cool Deepin project when I was in Vietnam. They had a very, very interesting idea and it made a lot of sense. And these guys all came from the telecommunications space. So they were real professionals. But they had a token. And I was like, what's the use case of your token? And they said, the revenue that we earn from the company, we're going to buy back the token on the market. That is a really stupid use case, right? Like, that is very simple. And they're just using that to pump the token to get early liquidity. And then they're going to cash out. And you think about it from like a founder perspective. Like, what's the usual route to launching a company? It's like starting the business, bootstrapping, getting some traction, finding product market fit, hiring, firing, persevering, raising capital, failing, then succeeding again, then raising more capital, and then eventually getting acquired or you IPO. And that's a 10 to 15 year journey for these founders. And it's a lot of blood, sweat, and tears. But then crypto switched the whole thing around, right? You could launch a Twitter page, a cool website, and in 6 months' time, you can make millions of dollars. Of course, you're never going to build the product. Why would you? There is no incentive anymore. Like, you've cashed out already. You've already sold the business. So for us, our main focus is investing in equity. We haven't seen anything that's interesting from a token standpoint. We can invest in it, but we haven't seen anything yet. So, and we also look for stuff that's actually launched. So we don't invest in ideas. We love to support entrepreneurs that have great ideas and are launching something. So we have different incubation programs, hackathons, residency programs. So that sort of acts as a funnel for us to get exposure to these guys. But we don't invest in products that haven't launched and don't have customers already. So we need to see product market fit. We need to see growth, and then we'll invest at normal, rational valuations. No one is going to argue between a $3 and $5 billion valuation. Like, we don't care, but we will. If someone is raising at a $30 million valuation versus a $3 million valuation, of course, then we're going to pass on that opportunity, right? Because at the end of the day, this company has to get acquired or it needs to list. And if you're investing at $30 million and they sell 5 years later, they're probably only going to sell for $30 million. So yeah, I mean, but we've seen such great opportunities, and the market is changing in a big way. The products that we've engaged with are scaling like crazy. They have constant month-on-month growth, very different to a couple of years ago. So people are using these products now. I mean, I think in the beginning, it was a lot of tech-savvy people that understood crypto, but they didn't know how to commercialize things, almost like Steve Wozniak's. They were the first adopters of crypto, were the super nerdy tech-savvy guys, but they didn't know how to market anything or commercialize it or build proper UX and UI. But as the market matured, the Steve Jobses of this world are now partnering up with the Steve Wozniaks, and blockchain is becoming in the background, and these apps are becoming very easy to use. The UX is better. The commercials make more sense. So yeah, it's a super exciting time, I think, for emerging markets in general. From an investment standpoint, I think is exciting, not just from Web3, but I think Web3 as the catalyst technology to drive fintech use cases is what's going to be interesting. At the same time, I don't think you're going to see many new Web3 funds launching, because Web3 is going to be in everything. So it should just be a Web3 fund is not going to make sense anymore. I think more and more general funds are going to be investing in startups that use blockchain in their tech stack because they have to, and it's just a better way to do things. So I don't think you're going to see many new Web3 funds launching. At the same time, there was a cool announcement that went out recently by Andreessen Horowitz. Ben Horowitz posted on his Twitter and his LinkedIn account that they raised $15 billion in 2025. This is money raised into their funds, into various different funds. And he was saying that was 18%, as an interesting stat, that was 18% of all venture capital raised in the US. They raised 18% of it, which is crazy, right? So $15 billion. And he said their main focus is going to be AI and crypto. But like crypto infrastructure, not crazy coins and shit like that. So even though AI is the sexy thing now, blockchain is the infrastructure. And I still think there's a lot of opportunities for investors and for entrepreneurs that want to build something in that world.
So yeah, going back to first of all, cryptocurrencies and crypto projects in general, even if they don't have the utility, you look at some of the metrics, right? And I just saw a post on LinkedIn about I forgot which coin it was, but like it was like a top 20 in terms of market cap, but like the monthly revenue that chain was generating was like less than $1,000, and it's just like stupid because that particular project raised like hundreds of millions of dollars. So like, and I also agree with you that like early in the days, you would have a lot more tech guys and these developers and these maybe nerds in this space. But then I kind of got the feeling that everything was being dumbed down too much. Like we had all of this meme coin meta and this degen phase of crypto, and the likes of Solana did not help on that at all. But like, I fear that maybe we went like too much in the other direction. But now I think with everything becoming much more institutionalized, we're kind of like getting to a middle ground between, more traditional marketing, but also like having these early guys, these developers. So now I want to ask you a question from a VC standpoint, because emerging markets, right? They aren't like monolithic. I'm not sure if that's the right word to use, but like we have, for example, the likes of Latin America, we have Africa, we have Southeast Asia, we have the Balkans, and all of them have like very diverse cultures and like business environments in general. So how do you like adapt your approach when evaluating a startup from, let's say, Vietnam versus one from Nigeria? Like, are there regional differences like in how founders pitch and like what general challenges they face that you have noticed through your programs?
Super good question. And if I started this fund with two other guys, we wouldn't be able to focus on such diverse markets because we wouldn't have access to the deal flow and we wouldn't know what's going on, right? So the only reason that we have the luxury of investing across all these different markets is that we have quite a big team. Obviously, Lisk being a blockchain infrastructure business themselves, we can leverage off of quite a big team and lots of partnerships. So we work with and fund many different incubation programs, acceleration programs, different ecosystem builders, governments. So we have partnerships with the Indonesian government, more recently United Nations. We're doing a program with them as well. We have partnerships in Nigeria. So the main countries that we're currently focusing on, because of your question, right? Like because of how difficult it is to understand these markets, we can't just spray and pray, of course. That being said, if we get a really interesting opportunity from Kosovo or Pakistan, we can still look at it and we can still invest because our thesis is emerging markets. That being said, the majority of our deal flow is coming from where we understand the markets, where we have employees on the ground, and where we have partnerships. And that will start to grow over time. But currently, it's Indonesia, Vietnam, in Southeast Asia. In Africa, it's South Africa, Kenya, and Nigeria. And then in Latin America, it's Argentina. So the majority of our deal flow and all our portfolio companies to date, only 5, are from those regions, right? So because if we start saying we're going to invest in Pakistan, we don't understand the market, we don't understand the problems there. Of course, there's similarities between all emerging markets. But for us, what we've noticed is that in Argentina and those countries in Africa that I mentioned, most of the use cases are fintech related. 90% of them are fintech related, and in payments. In stablecoins in Argentina, a lot of people are using USD stablecoins. When I went to Dev Connect there was a startup called Peanut. In their first month of launching, they did $2 million in volume, in payment volume. So these are people utilizing Peanut to pay with stablecoins, using the Mercado Libre terminal, which is like the payment terminal that they have there in Argentina. And they're using this app to do it because of the issues that they have with the local currency. But in the same time, in South Africa, as an example, USD is not necessarily widely used. because although our currencies are depreciating, they're not depreciating at such a rapid rate that some others are, like the Argentinian peso. So it's still a very stable currency in South Africa, as an example. So we are starting to see rand-pegged stablecoins here and different use cases for them because it's cheaper, money moves faster, you can exclude banks from the equation, so it just makes sense. And USD becomes sort of the bridge because it's the way to use international remittance because of the lack of liquidity in these different markets. But most of what we're seeing in Argentina and Africa is fintech related. Some really interesting certification and verification use cases as well, but I think those will struggle for adoption. I think payments is definitely where the adoption is going to be. Southeast Asia, we've invested in a really interesting stablecoin there called IDRX in Indonesia. But the rest of the deal flow that we've seen hasn't been great. We have been a little bit disappointed. At the same time, we still need to give it more time, and we want to explore the country more. We have boots on the ground there, and we have partnerships there. And I've made 2 trips myself. We have other team members that have explored quite a bit as well. And then we did a retreat in Bali for 2 weeks. We invited loads of startups from the region. We had some competitions and whatnot. But a lot of speculative stuff still. Gaming, etc. But there is still a lot of really cool stuff there. So we still need to dig deeper into that region. But we did find a gem with the stablecoin, so that's great. But it's very difficult, as you say, to get deal flow from Nigeria, Indonesia, and Vietnam. Like culturally, they are so different. So we have to rely a lot on the employees that we have on the ground and the local partnerships that we have to understand if the use case makes sense. If they're on the right track, are they in line with regulation? So we have to leverage a lot of people on the ground to make these decisions.
So we talked about stablecoins, and everyone that I talk to, they say that stablecoins are one of the financial assets in Web3 that actually founded PMF internationally, and people actually use them because they need to. But I've seen a report from, I think, McKenzie, if I'm not mistaken, and Artemis, and I think, if I'm not mistaken again, that only a very small percentage of stablecoin usage is accounted, to real payments, right? And remittances and everything. I think it's like around 1%, and the rest is crypto trading, basically. So I want to ask you, like, when do you think stablecoins will actually become the next financial instrument that people will use, and when will this use case be way more and way bigger than only crypto trading? Because it's still just an echo chamber, even in not just stable coins, in most of the things. It's the same people doing the same things over and over again, and the numbers getting pumped. But when do we see normies start using the stable coins, let's say, more and more?
Yeah. So I think the best way to know that if a stable coin is succeeding is the fact that you don't even know you're using a stable coin, right? So I think we're starting to see it now in Africa, where it's very much in the background with some of the local stable coins. So I was actually, funny enough, talking to someone about stable coins yesterday, and I have some tabs open that I was going through with him. So there's obviously IDRX in Indonesia. That's not necessarily the use case. Obviously, that's just the infrastructure and the stablecoin itself. But there's all these different businesses that I was showing. There's one called Paid that we invested in now that does international remittance. They have to use stablecoins to do that. If you're in Nigeria, for example, and you're invoicing your employer in the US, your employer pays into your bank account in Nigeria, and you can lose up to 20% of that money. So you're losing 20% of your salary is insane. And of course, it's archaic and old school, and it takes a lot of time to actually let the money reflect into your bank account. So he's developed a solution called Paid, P-A-Y-D. It's very similar to Deal in a sense, where it's facilitating payments for contractors. But they have to use stable coins to make it instant, right? So they're using local stable coins to make these payments instant without the fees. So we are seeing it being used. That's just one use case, right? There's many others as well. And it's very much now in the background. And I think what we will start to see with crypto is that it starts to become more and more in the background. But I do agree with you that the majority of USDT and USDCs float comes from trading and people holding it on exchanges. And that was the core use case, but it is starting to shift into payments as well. That app that I mentioned in Argentina called Peanut, they use, I can't remember which stablecoin, if it was USDT or USDC, I can't recall, but they use that to make payments, right? So it is starting to happen for sure. So I think we're going to see it now this year.
Yeah, and like, how is Lisk trying to push for this stablecoin narrative? Like, what are the steps you guys are taking to basically, because you mentioned multiple projects that you guys are working with, startups that are focusing on stablecoins, but what's your go-to plan, right? In let's say like the next 3 to 5 years.
I mean, so we're a blockchain infrastructure business, right? We're a layer 2 blockchain, but it's a very bad business model because we have to get crazy amounts of adoption in our network for us to make any meaningful revenue. So the focus for us is actually shifting away from the chain and we're building a very exciting product internally. Our chain still functions. It's built within the superchain ecosystem. So it's an EVM chain. And we focus a lot on adoption for emerging markets, but it's very difficult to compete with the likes of Sui and Solana and of course Base. And those grant programs don't work. Investing, like giving someone a 100K grant, locking them in for a year to build exclusively on your chain. After a year, they're either going to go grant farming somewhere else, or they're just going to migrate to a chain that's better for them. And in many instances, that ends up being Base currently for a lot of startups that we engage with. So we're building something else now, which is quite exciting, which will come out in the next few months. We understand that we also have to make pivots as well. So on that note, our fund is not an ecosystem fund. So we can invest in a startup that's built on Solana, on Base. It doesn't matter. It's not, I mean, the amount of deal flow that we would have if we forced people to build on Lisk, or we only engage with people that would build on Lisk, wouldn't make sense to have, a fund that can make meaningful returns and invest in the best startups of the future. So we also understand where the market's going. At the same time, we do a lot of these different, we support a lot of different initiatives. As I mentioned, we do lots of incubation programs and hackathons, build-a-thons, startup pitching competitions. We did a residency in Patagonia where we invited a whole bunch of startups there. We did something like that in Nairobi as well and in Bali this year. So we're trying to drive and give exposure to as many founders as possible that are building that are still too early for us to invest. It also gives us the opportunity to have all this deal flow. But of course, there's only so much that we can do. But the market is starting to shift naturally on its own. But we definitely see ourselves as a driving force for all of this. And at the same time, what we're also putting a lot of energy into now is trying to act as the bridge for international capital. So we invest into a startup, let's say $100,000 in their first round. They start using that to get more traction, to grow the business, and to start preparing for a more meaningful Series A. As an example, let's say they're raising $5 million. They won't find that. If it's an African company, they won't find that in Africa. It'll be very difficult. So they have to look outside the continent. We've spent a lot of time over the past couple of months engaging with many VCs in the US and other developed markets, which has been really interesting to get their feedback on how they see the market. And all of them are saying the same things I've been saying during the podcast about them struggling with returns and deal flow being over-evaluated, etc. So for us, it's very easy for them to take the call because we're not another generalist tech fund. We're a fund focused specifically on emerging markets. We can give them deal flow that they don't have. So we see ourselves as a bridge to give startups in these regions access to international capital. So we're starting to develop a database and understand the mandates of these different startups. And when we have someone that's raising, for example, that $5 million Series A, and they're in biotech, blockchain as infrastructure, but biotech as the industry, for example, we can then make the introductions to VCs in developed markets that are looking for that type of product at that stage. So for us, that's how we will be trying to participate and drive more capital flowing into these different startups.
Yeah, now I want to take things into more like a personal level. I have a couple of 3 questions.
Sure.
So before Lisk, you managed on CVVC.
Yes, that's correct. Yeah.
And so like what were a couple of like of your biggest takeaways from that experience? And then prior to that, you also were a founder, if I'm not
That's
mistaken.
great. Yeah.
And how does that experience like influence your style as an investor now? Like, do you find yourself maybe more empathetic to other founders? And like, are there any principles from your like early days that you try to maybe instill in the startups that you back?
Yeah, so I'll start from my founder experience. I had this food tech company called Green Machine, but I was influenced by what was happening in the US, reading Peter Thiel's 0 to 1 book, Steve Jobs' book. So I thought, I'm going to start this company. I'm going to raise a shit ton of money and take over the world. This is going to be great. That's not what happened. It was freaking hard. I had to sell my car at one point. The VCs that I did meet, and there weren't very many at that time in Africa, said no. So I had to bootstrap and actually get traction, and that took a while. And eventually we did get product market fit, and we got funding from a private equity company called Acorn. And then we eventually sold to a company in South Africa called Montague. So it was super difficult. And then translating that into my experience in the VC world and also what I experienced at CVVC, I think I was romanticized and overly excited about how Web3 could change the world, that we spent a lot of time investing in startups that were at the idea phase. And we all have great ideas. Everyone has great ideas. You lie in bed at night, you look at the ceiling, and you think, wow, that's a good idea. So the idea and the strategy is 1% of the journey, right? It's all about execution. So we do a lot more due diligence on understanding, is this the type of founder that can scale this properly? That's one thing I've learned, is really to focus on the people even more. I think earlier stage you are as an investor, the more important it becomes about people. Later stage, it's different because the product has proved itself. You don't have to do too much due diligence on the people. You can see the growth in the spreadsheets. This is a very different type of due diligence, being an early stage investor. And then the second one, which might be counterintuitive to what I just said, but the second one is investing in stuff that is actually working. So that is actually launched, and we do have the luxury now of the market being more mature. So there is more deal flow out there of projects that have already launched, where back then there were less. But you can get overly excited and you can caught up by a great salesman that has a good idea, but nothing ever happens, right? Or at least the execution is poor. So for us, we de-risk our investments by actually seeing that the product is launched, that people are using it, and they have some sort of traction that shows product market fit. Doesn't always have to be revenue, right? Instagram is a great example of that. They had thousands of users, millions of users, before they had any revenue, because they were waiting to get to that point to just switch on advertising. But you could see that this product was validated by the amount of people that were spending time on it and the amount of users that Instagram had. So for us, we need to see some sort of traction, and we need to see growth. So very often we see a startup that launched the product, they have some users, but they're stuck. So they have, like, if you had to look at the graph of revenue or users, it's like very much up and down or flat and sort of plateaued. And they have the promise that the money will unlock growth. Sometimes that is true. Most of the time it's not. It's just bailout money so that they don't close their doors, right? So we have to invest in companies that are going from growth to hypergrowth. And that company I mentioned, Paid, where we signed a term sheet with them 2 weeks ago, is a great example. They've just been growing since January. We met them in February, and February last year, and they were showing promising traction. But I said, let's see if it continues. The next month it continued, then it went up again. Fast forwarding to the end of the year in October, they did $500,000 in transaction volume. We still were thinking it's a little bit small, but let's see what happens. November, they did $850,000. And then in December, they did 1.6 million. And then we signed the term sheet very quickly before they changed the valuation. So I think you need to see traction. It sounds like a cop-out and a very basic thing to say, but I think a lot of investors get caught up in like the romance of these entrepreneurs trying to change the world when there's nothing there. At the same time, in emerging markets, we have the luxury of waiting. This founder, for example, that we basically waited an entire year to make the investment. If that was in the US, we would have missed out on the investment for sure. So obviously there's just too much capital in the US. So founders are able to raise money on ideas. That's why I think being an investor in emerging markets is very exciting, because you can wait and you can let the proof of the project speak for itself, right?
Yeah, so now that we're talking about founders and your experience as a founder and everything, what are 3 tips from your experience to startup founders and let's say entrepreneurs that are young and are trying to build something in the future?
So the one super important thing I would say is that don't have side hustles. So not everyone has the luxury to go all in. I understand that. So you may be working a corporate job and on the side you're building a startup. That I understand. Those scenarios sometimes are the only way to get something off the ground. But at the same time, what I'm more referring to is, you have a startup founder that's building something, but they're trying to leverage this opportunity with 3 other things, and they've got like this side hustle and that thing on the side. Like, you want someone that's all in. Are there exceptions to the rule? Obviously. Elon Musk is a great example, right? He is the CEO, or at least the chief of many different very successful companies. But as I say, the rule is that you all in. So I think if someone wants to raise capital or be successful in their project, I would encourage founders to go all in as soon as they can, and then focus on getting product market fit before focusing on raising capital, and then the capital will flow. I think those are the 2 most important things. And then also remember that a startup, a lot of people would answer the question that you asked me now as don't do it, right? Because it is a freaking emotional roller coaster. Like, one day you feel like you're taking over the world and things are flying, and the next day it's just like, shit, where am I going to pay? Like, how am I going to pay salaries next week? Or, so it is an emotional ride. So you've got to be ready for the turmoil. But I would obviously encourage people to build their own business for sure, right? It's an exciting thing to do. But you got to go all in. You got to get ready for the emotional experience that you're about to have, and at the same time, you need to focus on launching a product. Don't perfect things too much. I think people become overly obsessed with perfection and then they don't actually launch anything. So just launch something, see if people want it, get data from users, and iterate it based on the feedback that you're getting. But launching the product is super important, and then focus on raising capital.
Yeah, launch first, polish later. Like, that's the philosophy from myself as well. And you mentioned earlier that AI is one of the fields that you guys have backed and that believe that has really good fit, for example, with the retail, even with different demographic structures. And but like, there's this constant fear that maybe it is a bubble as well. So I want to hear your take. Do you think that maybe it's a bit overvalued or oversaturated, or it's not enough maybe?
No, I think it's definitely overvalued. I mean, the projects that we see that are leveraging AI aren't using it as like the core USP of the company, but they are integrating it to just improve their product. But they're not an AI company like Anthropic or OpenAI or Gemini, etc. They're not. It's not AI infrastructure. They're leveraging these LLMs, integrating it into their customer experience to just be better than their competitors. But it's not an AI company. So we haven't seen many AI companies leveraging crypto yet. But most of the companies that we invest in have AI somewhere in their in their tech stack or for the user's experience. They're quite often are interacting with some AI agent or AI chatbot or something, right? But I think AI is definitely overvaluated, but it will change. The market will correct itself. And I don't think there'll be many winners in that space, at least at these crazy valuations. But the infrastructure guys are going to be the winners for sure. The Anthropics of this world, OpenAI, etc.
Yeah. Now, okay. I'm gonna go for it. So you said that you like have backed like different projects in AI, RWA, stablecoin. So was there any chance you also back crypto podcasts, for example?
Hey, it could be, man, for sure. Who knows? You have to figure out
Good.
what your
So
mind
there's
is, right? Like, what stops people from replicating what you're doing? Obviously, people can launch a podcast quite easily.
Yeah.
How do you go from whatever your revenue is now to 20x that and build a community of hundreds of thousands of listeners? And then I'm in. Let me know when you get there.
Yeah, well, that's the thing. Like how do we get to the 20x?
I think I mean, you need to, like, why would someone listen to your podcast versus someone else's? Of course, I think that's like the core
Yeah.
fundamentals of the project that you guys are driving is, how do you get listeners? And how do you turn 1,000 listeners to 10,000 listeners? And at the end of the day, a lot of that is going to be through really strong guests, right? That act as a credibility stamp. Of course, if Joe Rogan interviews Donald Trump or Elon Musk, that gives his show massive credibility. And then there becomes a virality loop through the guests that he invited. So Donald Trump then tweets, I was on Joe Rogan's show, and he has millions of followers, and then you have a distribution channel. So I'm definitely not that guest, right? But if you can find a guest that's willing to give you a shot, that can act as a distribution channel to more listeners and give you that credibility, I think that's your first step.
I mean, look, Joe Rogan cannot say that he had Gideon Grease on his podcast, right?
No, you
Or
cannot.
like,
Unlucky for him.
yeah. So, points for us, right?
Yeah, exactly.
So, like, another question that I have, like, maybe to also wrap things up a bit, what would success look like for you for this industry in, let's say, 5 years? And I don't want this to sound like a job interview question, you know, where they ask, where do you see crypto in 5 years and stuff? But like, I just want to hear like your take from a VC standpoint as well. Like, what should we expect for this industry that we love and cherish every day in the next 5 years?
Yeah, so I'll speak on a couple of points there. One, just from general blockchain standpoint, I think everything is going to be tokenized. I think money systems will be leveraging blockchain. All financial products will be tokenized. And then we'll start to see some really exciting stuff, like tokenized watches and stuff like that you can invest in. I think certification, verification, everything will be on chain. So if you get a university degree to verify that it's true, it'll be on chain. We still have driver's licenses that are cards. These will be in wallets. There'll be verified, digitized versions of what a card would be. I think money will eventually die as well, paper money. That will all live in different wallets. I don't know the timeline of this, but 5 years sounds great. And I think AI will accelerate this as well. And then from an emerging market perspective, my view is that more capital will flow into emerging markets, and there will be more excitement about what's happening in these different emerging markets. Talent and capital still comes from the US. I don't think that will change overnight, but I think that there will be a lot more VC firms and investors popping up locally across all different frontier and emerging markets. At the same time, developed markets will start investing more and more into emerging markets. And hopefully Elon or somebody figures out how we can all live forever. That would be great. That would be my goal. Not to die.
I mean, that's everyone's goal. I'm waiting for that. What was the name of his microchip company? Neurotech?
Neuralink. Yeah.
Neuralink. Yeah. I'm waiting for that to be like mainstream and be commercialized, so everyone can buy them. But yeah, you mentioned tokenization, and I know Dren said to wrap things up, but I have to touch upon like RWAs before we end the episode, because I saw a paper from someone in a university in Australia, and he had quite a good breakdown on RWA right now and how it's just not growing, right? Most of the money that's coming into RWA or tokenization is from gold, like PAX-G, PAX-G, I think that's how we pronounced, and then the Tether gold stable coin, or how do we call that one? So why is this? Because I know that there's like quite a lot of push in regards to tokenization. Most of the big institutions, BlackRock even has its BIDL project. So why aren't we seeing the growth? Like, it's been 2 years, I think, since RWA has been a thing in the market. So what's the issue, man?
So I think it's happening quietly in the background. There's a company that's about to list in the US called Securitize, with a Z at the end, Securitize, and they focus on tokenizing financial products. They've tokenized one of BlackRock's funds, Hamilton Lane, KKR. So these are some of the biggest funds in the world, billions of dollars under management, and they've been tokenized through Securitize. And Securitize is about to list on one of the US exchanges at multiple billion-dollar valuation. So that also validates that it's actually happening now. You just don't see it though, right? Because as I said, this technology is becoming more and more and more in the background. So if you want to subscribe to one of these funds, this is usually the process where it looks like. It's so old school. It's the same for Lisk, right? If you wanted to subscribe, and we're tokenizing our fund now, we're doing it in the next couple months, the next 2-3 months. If you wanted to invest in Lisk's fund, or you wanted to invest with BlackRock, obviously, unless it's a exchange traded product like an ETF, it's different. But if you wanted to invest in a private fund like Hamilton Lane or KKR, one of the private equity funds, you then get sent a 90-page document, plus minus. This tells you what you're investing in. So you have legal recourse in case they do something else. You read this 90-page document, you sign everything, then you do KYC. Then the fund administrator that's liable for that fund will then email you and ask for all your KYC documents. Then you wait another 2 days because they're busy. And then they do the KYC. Then you get sent basically a statement for you to make the payment into a bank account. Eventually, this will be as simple as when you sign up to an exchange, like you sign up to Binance, right? You sign up onto Binance, you do KYC digitally, everything's done on your phone, and then you're in. That's exactly how it's going to become investing into these products. Instead of signing all these documents, transferring money, everything will be digitized, basically. So it'll be much easier for you to get your money out as well. So if you wanted to get your money out the fund, depending on what the fund's thesis is, you have to wait a certain timeline, you have to email them, then it's 30 days until you get your money out. Tokenization is just going to make things happen instantly. And if the whole process becomes digital, basically. So these markets, like Lisk's fund, which is usually very difficult to get into, in Lisk's fund or any VC fund, it takes time, it's archaic, it's old school. Through tokenization, you can go to Lisk's website and you could subscribe to the fund automatically. You could just follow the steps like a widget, do the KYC, and do the payment, whether it's crypto, Apple Pay, or if you wanted to do a bank transfer. So I think basically, so to answer your question more directly, it is happening, but it's very much in the background. And it's only for financial products now. As I said in the beginning of the podcast, the start is financial products. The future will be many more things, I think.
Yeah, and I've seen Securitize, and I mean, it does make sense, right? I don't see it because I've been focusing on different things like Deepin. I'm obsessed with Deepin right now and stablecoins, but it's happening and it just makes sense. We have all this technology, verifiability, traceability. You have ZK proof now, ZK proof, like zero knowledge proofs, and everything can be done digitally in an institutional grade manner, right? So I do agree on that. And yeah, Gideon, thank you very much. It was a pleasure having you on the episode. I mean, we're probably going to have a few more episodes in the future because, as you mentioned, you're going to be launching quite a few things in the next few months. So we want to talk about those things as well.
Sounds good.
And yeah. I mean, enjoy your day today. I hope your Monday is amazing. And yeah,
I appreciate it.
Again.
I just train. You guys are legends. Thank you so much. I appreciate your time.
All right, so key takeaways.
Yes.
Emerging markets will take over. So
Yeah.
they will emerge.
As markets, by the way, guys.
And we will surpass Joe Rogan in terms of podcast ability.
You heard it here first. And also, the other actual not so important takeaways. Stablecoins are the future, and RWA is moving forward, I guess, although many reports are saying it's not. But it looks like, I mean, it just makes sense. Everyone's talking about RWA right now, BlackRock and everyone else. That's like the big institutions are working on that. So they're going to make it work, or else there's not going to be anything to make.
Like RWAs are like that thing that you know that it's there and you know that it will be there in the long term, but you just don't see it every single day.
It's
right?
like an industry plan. Let's just call it that way.
No, it's kind of like the opposite. It's like the most organic.
I don't see it as organic though. because I mean it could be organic, but it's pushed by it's not pushed by the masses, right? It's pushed by the institutions. It's pushed by the people that control the money, which
But
I
they
support
do.
you guys, and I hope you give that like a small portion of that money to people who aspire to make great things, like Dran right here, or possibly me. I'm not sure, but yeah, you get my point, right? Because RWA. When did you first hear about RWA?
Like 2 years ago, maybe.
Yeah.
I mean, I don't know, but like my point is that they do have a use case, like much more than a lot of other products that we have in crypto right now.
NFTs have a use case, bro, but like I'm gaming. Come on, like guys, support me here. But not for real. What I'm trying to say is, yes, they do have a use case, but what project do you know that is actually taking steps and has users because of tokenization of a specific asset class, or like let's say private equity or whatever, or tokenized treasuries, because everyone's mentioning those. Well, you can't. You have auto
Good question,
finance. Yeah. Amazing question. But yeah, I mean, what I'm trying to say is that I think there's this huge disconnect of education and information that we have within the industry. And I mean, I'm going to talk about Twitter and X right now. Like, Nikita, I used to hate you when you started killing CT, but now I love you. So yeah, keep killing CT, keep being hard, and to everyone who's listening, stablecoins, RWAs, and startups. We love you guys. Thank you.